After that, how do we measure the risk? The risk which is measured by way of calculating standard deviation and the normal distribution, sensitivity analysis, and tables and trees, the decision trees, etc. So these are the concepts what we are going to learn here in this particular last chapter. This is the last chapter, risk and uncertainty. Now, when we talk about what is risk, technically speaking, both the terms risk and uncertainty talk about the same thing. That is, see, when planning is taken up for the future, so whatever is the future, what would happen in the future when it is estimated, when it is planned, it is not necessary that whatever was planned for the future, it would happen as it is. It would see, because future is unknown, nobody knows, and precisely estimating something for the future is not such an easy task, and it's not so simple. Anything can happen in future. So at the time of planning itself, if they understand that whatever they are estimating, there is also a possibility that the planned or the estimated figure for the future would not happen. Let's say that, for example, if they are estimating that the next period there would be a demand for their products as 10,000. If they also understand that it may not be 10,000 also, so that possibility is also there. If they understand that it may not be, because they see that some way that the demand would increase, maybe the competitor, some competitor is weak, and then their demand also can be diverted to that. So they see that either it could be 10 or it could also be 12,000. So right at the time of planning itself, if they understand that there is a possibility for a variation, planning, they are looking at a plan, they are estimating something, but at the time of implementation, they also see that something else also can happen. That is a variation. So when there is any variation from the plan, then we call that variation in the planning to be as either risk or uncertainty. Both of them, it basically talk about the same concept. It is either risk or uncertainty. One second, just a minute, just a minute. Okay. Um, what is um, what is risk and uncertainty? The concept that when there is a variation in the plan, then that is called as either risk or uncertainty. Now, how do we differentiate between what is risk and what is uncertainty? See, we see that there is a possibility for a variation, but the variation and the probability also, if it is known, then uh, that is called as risk. When the likeliness of such a variation is not known, that is called as uncertainty. Let's say that if on a cloudy day, if somebody says it would rain, what is the chance that it would rain? Because it's a cloudy day, they may say that 80% chances are there that it would rain. Or uh, if they see that 10,000 units would be sold next month, what is the chance that 10,000 units would be sold? We see 70% chances are there that 10,000 units would be sold. So there is some percentage of likeliness that such an event happens. If that is known, then it is called as risk. If the likeliness of a variation, we just understand that there would be a variation, but the likeliness of the variation is not known, that is uncertainty. Both of them basically talk about a variation in what would happen in the future. So that is either risk or uncertainty. But the the variation along with its likeliness of happening or the probability of happening is also known, then we call that as risk. Otherwise, it is only uncertainty. So What is the probability? Probability is the chance of a particular outcome happening, or probability, likeliness, or the chance of a particular event happening. All that is probability. What is the expected value? The sum of the expected value is calculated as, let's say that for a particular event they are anticipating that they can earn a profit of let's say that 5 million, or 6 million, or 7 million. Let's say that they are anticipating that three different possibilities could happen to their business, that they can ultimately earn a profit of 5 million, or 6 million, or 7 million. But then is that just sufficient, that there are these are three different possibilities what would happen in the future? Along with that, when the probability, what is the chance that, or what is the probability that there would be a profit of 5 million? Let's say maybe there is a 50% chance that there is a 50% chance that um, the profit will be 5 million. There is a 30% chance that there would be 6 million profit. There is 20% chance that there is 7 million profit. So if these things are known along with the different possibilities of the variable, anything, so these are three different possibilities which can happen. Now, each of them, when they are multiplied into the respective probability and add them up, the sum total of all the expected values multiplied into their respective probabilities will be the total expected value. Expected value is the sum of possible outcomes. Weighted. Weighted is probabilities if they are considered as weights, and the outcome, some outcome is considered as x. So the weighted average will be sigma wx divided by sigma w. So the expected value is nothing but the weighted average of that particular outcome or that particular variable. So the weights here would be the probabilities. Multiply the probability into the variable, and when we find out the sum total of that, that is the expected value. Okay, so this is also one thing which we have to learn. I said that there are four things, so in that fourth one, this is expected value. What is risk? Risk, the term risk talks about the quantifiable likelihood of the outcome being different from expectations. Different from expectations is there is a variation. If there is an expectation, and if a different thing from the expectation is also a possibility, if there is a variation also known, if there would be a variation also known along with its likelihood of happening. Likelihood of happening is the probability of such a thing happening also, if when it is known, then it is quantified. How is it quantified? The quantification would be what are the variations into what are the likelihood or the probabilities. When they are multiplied, the sum total of it is called as risk. So expected value of risk is equal to sigma, the variable, into its probability divided by total probability. Total probability is always equal to 100% or 1. Okay. Then what is uncertainty? Where either not all of the outcomes can be identified, or the probability of their occurrence cannot be quantified. So when that is not known, variation would be there is known. But how much the variation, either it is not known, or if they understand what is the variation but they do not know what is the probability, then such a thing is called as uncertainty. What is standard deviation? Standard deviation, we've learned that in statistics, mathematical tool which is used, standard deviation, a mathematical expression of how far a range of possible outcomes are spread. Let's see that in a class of 50 students, there are 50 students. What is the average mark in mathematics, if that is what is asked? So what do? We add all the students marks divided by the number of students, that is the average mark. So um, let's say this is a classroom. Let's say some value, average value is this one. What does it mean? Let's say 80 is the average mark. What does it mean? It means that it's not that everybody gets 80, but it means that most of the values are located in and around this 80. So when we plot them, we see that most of the values are located around them. So this value is centrally located. But does it mean to say that everybody would have closer to 80 in 70s or in 80s? No, somebody might have got 40 also. Someone might have got 100 also. So there is a chance that there is a deviation also possible. If the average mark of that particular class students marks in mathematics, if it is given as 80, it doesn't convey that everybody gets 80. It conveys that most of the marks are around 80. But there is a possibility of a deviation also. So even if one student gets 40 also, so that is a deviation from the centrally located. That is a dispersion. That is a deviation. So what is that? Let's say somebody is far away from this 80 with a mark of 40. So what is the chance that such a thing would happen? If we are talking about on an average, the profit for the firm is some amount. If it is 5 million, it is not necessary that every time they would earn around only 5 million profit. There could be situations where there may be a loss also incurred. That possibility is always there. What is the chance that such a thing would happen? What is the percentage chance that there would be a deviation from their average return or average profit? That is measured by standard deviation, a mathematical expression of how far a range of possible outcomes are spread. A wide spread gives a higher standard deviation, which implies higher degree of uncertainty. If there is too much of deviation, the risk is also quite high. If the deviation percentage is low, it doesn't deviate much. It would be centrally located around a particular value. But if the values are quite far away and the many values which are away from this centrally located, then the volatility is high and then the risk is also high. Okay, by way of measuring the standard deviation, calculating the standard deviation, we can have an understanding about what is the amount of uncertainty which is present in the organization. Now, technically, and those are the concepts what we have to learn. But then, technically, what we have to learn is what are the attitudes towards risk. Now, suppose in a family also, we see that generally we see that elderly people they go in for investing in bank accounts. They choose FDs. They choose savings account. They choose postal post office certificates, government bonds. Why would they choose that? The main reason behind that is um, the security aspect. In any situation, they would not lose on their investment amount. So at least they will get back their amount. So they are looking at their focus is about looking at the return, the investment in more than the return. Their focus is always on getting back their investment amount. Okay. um, See, but the profits which are earned on, or the returns which are earned on FDs or post office accounts or savings accounts, when we compare with other investment opportunities, they are not much high. They are low only, but still they are not looking at the interest which can be earned or the return which can be earned. But what do we see? They see that this is safe, this is secure. But in the same family, the younger lot, the people, I mean, younger to them, if at all if they have to take up an investment opportunity or take up an investment situation or invest in something, uh, their outlook is quite different. They think about investing in real estate, investing in shares and bonds, investing in gold, shares of stock market. Like this, we see that they look at something else which is more profitable. buy a land and sell it after a while so that they can maximize the return. But then uh, there is a risk involved in investing in real estate also. There are certain things which are associated with each type of investment. So in a family only we can see that different um, attitudes or different responses towards investment, we can see that. Now each of them comes with a um, perception towards uh, how this investment would be in terms of what is the risk involved. So that is what we can categorize it for various types of investors. Various types of investors, what is their response, what is their attitude towards risk. Risk is a variation. When there is a variation, when they cannot get the same thing whatever is the expected amount, um, if there would be a variation, the risk is present. Variation is risk. But somebody with an attitude of investing in that, also we see. But what is the reason why they would want to invest in that? Wherever risk is high, you must have learned about risk and return theory. Wherever risk is high, the return is also high. See, somebody is in thinking about investing in a stock market. Stock market, when they earn profits, they earn very good profits. But stock market is subject to volatility, subject to uh, many variations. So there is a possibility of also earning a loss, but there is also a possibility of earning a return. When the return is earned, their profit is very high. Good returns can be earned, but at the same time risk is also present. So here what do we understand here? There is a relationship between risk and return in a direct proportion. Okay, so direct proportion, that when risk is high, return is high. When risk is low, like in investing in a FD, bank account, savings account, post office, we do not see that much returns can be earned. At the same time, risk is also low. When risk is low, return is low. Return is low, risk is low. Returns are high, risk is high. So there is a direct relationship here. So considering that, the various attitudes of the investors can be categorized. Based on that, we have the attitudes of the investors mentioned out in um, what is the strategy which they would be adopting. One is Maximax is one thing, Maximin is another thing, then Minimax Regret rule. I think this part of it only was not Maximin. This is a typo. This is Maximin. Minimax Minimax goes with the regret rule. Minimax regret rule. Okay, so doesn't matter if this slide is, if there is a mistake, doesn't matter. Let's see, if we are talking about what is the attitude of the investors. Based on the attitude, they choose the strategy. That is, either they go with Maximin, Maximax, Minimax regret rule, and the fourth one is expected value. These are the four different strategies which can be used. Who uses what? So let's look into that. A pessimist is an investor who sees that there is a risk present and doesn't like to take up any risk. He's risk averse. He doesn't like to take up any investment opportunity where there is risk present. He wants to minimize the risk. Okay. So what is his attitude? So if this is Maximin, if we split this into two parts, we see the first part is Maxi, the second part of it is Min. Min is he would look at investment opportunities which give minimum return. Why would he look at minimum return? Because risk is also minimum. Okay, minimum return is what is the investor looking at. Minimum return, because associated with the minimum return, the risk is also minimum. But from among the alternatives where there are minimum returns. So first he identifies all the investment opportunities where there is minimum return. From among the minimum returns, chooses a maximum. So maximin, min is the return. But on the same note, if there is an optimist who looks at everything as bright and then possibility to earn maximum return, so he selects all the opportunities where the return is maximum. So all the alternatives or all the opportunities where the return can be maximized, he first identifies them. From among the alternatives, he selects the one which has a maximum return. Maximax, both of them are maximum. When the return is maximum, associated with that, the risk is also at its maximum. Max. Someone, the third category is the strategy which is chosen is Minimax Regret. What is Minimax Regret? He looks at what is the opportunity cost in every situation. What is the opportunity cost? Theoretically, even if I say also, nothing would be clear. We take my words, don't worry about it. We will work out the numerical questions, so then it becomes easier for you. Minimax Regret rule is a situation where uh, from every alternative, what is the opportunity cost? What is that he would forego? Is what is first assessed, and the regret, the investor wants to minimize it, minimize it the maximum regret. Here we are not looking at the return part of it. We are looking at the regret which is at maximum regret. So first identify what is the regret. Regret, it talks about the opportunity cost. So first identify the regret, then from among the regrets, choose an alternative which has a minimum regret. Maximum regret, minimize the maximum regret. Okay, then expected value. So we will take up numerical questions right now, and work it out. How do we calculate standard deviation? Just now I was explaining that there is some value which is far away from that. um, that is how we calculate what is the standard deviation. Numerically we will check it out. How do we substitute the values and then find out? Okay, first let's discuss till here, because this is a lot of content which is not regular for us. We do not take up these things, these concepts day in and day out, so little unusual for us these topics. Let's work out, and then I'll come back to the normal distribution. What is normal distribution curve? Expected value, anyway I already told you. Then to find out all these things, payoff tables have to be prepared. See, it is not that the data which is given, we pick out something and then arrive at what is maximax, maximin, things like that. It is not that simple. What has to be done is the data has to be first tabulated, present in a table. So table is a two-way table. That is, we see various alternatives which are presented horizontally and also vertically. So two-way table. So the data has to be first tabulated. After the data is tabulated from the table, the variables are selected so that we can apply the strategies: Maximax, Maximin, Minimax Regret rule, and expected value. So payoff tables are important. That has to be prepared to simplify the presentation part of it so that it can be taken up for calculation. Normally shows two factors, two-way table, two factors. One is horizontally, one is vertically. Okay, for example, demand, which forms one axis of the table, and supply, which forms the other axis. Then the table shows the different profits from each combination of demand and supply. Then probabilities are also used, and then we can calculate what is the expected value. Decision tree is a different topic. Let's get back to the examination kit. Don't worry, even if nothing went into your mind, head also, it is not that theoretically so simple and easy that you can pick it out from whatever we've done. Um, but as we are taking up the numerical questions, it becomes clearer. Don't worry about that. let me dealing with uncertainty, in the short term. Okay, risk and uncertainty in the short term. Question number 232 says the daily demand for a perishable product has the following probability distribution. So demand is given and the probabilities are given. Each item costs $4 and is sold for $8. Unsold items are thrown away at the end of the day. If orders must be placed before the daily demand is known, the number of units that should be purchased at the beginning of each day in order to maximize expected profit is. What did I do? How to go back? Done something. Hmm. Am I audible? I didn't even ask you. Question number 232. There are three different possibilities of demand given. The demand could be either 100 units, or it could be 200 units, or it could be 300 units. And for each of the situations, the probabilities are also mentioned. Okay. But there are three different situations which are present. One is the demand could be 100, or the demand could be 200, or the demand could be 300. But the chance of the demand happening is 100 units is 25%. Then 200 is 40%, and 300 is 35%. If only this set of information is given, how do we calculate what is the expected demand is? Multiply 100 into 0.25 plus 200 into zero point 0.4 plus 300 into 0.35. So that will be expected demand. But the question has something more also. It says that each item costs $4 and is sold for $8. Unsold items are thrown away at the end of the period. The rest of it says that if orders must be placed before the daily demand is known, the number of units that should be purchased at the beginning of each day in order to maximize expected profit is dash units. If it is known, if um, if the orders must be placed before the daily demand is known, then how many units must be purchased and kept it available? So uh, they should have the stock available with them. If they already know what is the demand going to be like, then now to cater to that demand, they will make arrangements. The arrangements would be about keeping 100 units on hand available, or having 200 units available, or 300 units available. So that is the concept there. Now the point is, how can they maximize their expected profit? So how many units should they have it on hand so that they can maximize their profit? If the expected demand is 100 units, they should have what is the required number of units, and see that they can meet the demand at the time. One second. Now this is a scenario. The point what we have to remember is, if orders must be placed before the, okay, Excel file is not visible. Okay, okay. Then see, to meet this demand, they can either, they're not sure about what would be the demand. The demand could be 100, the demand could be 200, or the demand could be 300. So to meet that demand, they have to make the arrangement, that is, to ensure that they purchase, that they keep the units available either as 100 units. Okay, it could be, if it is known that it would be 100, they buy only 100. They make arrangements only for 100 units. So there, a situation of arranging for 100 units is one possibility, or they can make an arrangement for 200 units. Okay, or they can make an arrangement of 300 units. See, all of them are expected things, expected demand. This is not the actual demand. So to cater to the demand, what if they make arrangement of only 100 units? Okay, they have to keep it available, and there is no carry forward of any stock. If the stock is not utilized, it would be if unsold items are thrown away at the end of the day. So there is no carry forward of that. If the orders must be placed before the demand is known, the number of units that should be purchased at the beginning of each day. So if they have to meet a demand of 100 units, in that case they have to purchase something at the beginning of the day. So if let's say if it is if they go with purchase of only 100 units, in that case what would be their profit? If they buy only 100 units, then in that situation of 100 units, what will happen to their profit? Or they can also take up a situation where they buy 200 units at the beginning of the day, then what will happen to their profit? Or they can also buy 300 units, and what will happen to their profit? That is what has to be basically now we have to calculate. Okay, what if they buy only 100 units? We see the each item costs 4 and is sold for 8. Okay, each item costs 4 and it is sold for 8. So how much is their profit? Their profit would be 8 minus 4 is 4. So 4, they as of now they have purchased only 100. So these 100 units will generate a profit of 4 per unit. See, I'll put it here. Selling price per unit is equal to 8. Cost price per unit is, they would be purchasing it for 4. Now they have purchased only 100 units. All 100 units will be sold. Even when the demand is 100, all 100 will be sold. So the profit will be, expected profit, what they can earn is 100 units into 4. Anyway, 4 profit cost price. So we see profit per unit is equal to 4. All 100 units would be sold. 100 into 4, because the demand, in fact the other two situations the demand is more, but all of them will be sold at uh, 4 per unit. The profit which will be generated will be at the rate of 4 per unit. Now if they have purchased 200, the demand is only 100. So then what happens? They have already purchased 200 units, but only 100 units is the demand in the first situation. The remaining unsold units, another 100 units would be there, but can they carry it forward? No, they cannot. That has to be just thrown away. So they would be purchasing that at a cost of 4, but the selling price what will be generated is only on 100. So cost of the if purchase is for 200 units and demand is 100 units, then in that situation cost of units is equal to 200 are purchased, each one at the rate of 4. Okay, so that will give us 200 into 4 is 800. But how much will they be able to sell? sale of units. How much will they be able to sell? Because demand is only 100. 100 into 8 is equal to 800. Is there any profit or loss? Zero. As much as they have spent, that much is the revenue. So there is neither profit nor loss. Zero is the profit. Then now we see that 200 are purchased. So 200 units. Profit part is 4 per unit, isn't it? You see that. So 4 into 200. Any doubt? Did you understand this point? No response. Please respond.
Yes.
Got the point, no?
Yes, ma'am.
Yeah, done. Good. What if they purchase 300 units? If purchase is for 300 units and the demand is only 100 or 200. If the purchase is for 300 units and demand is 100 units, then cost of 300 units will be 300 into 4, which is equal to 1200. Sale of 100 units will be 800, so there will be a loss of 400 minus 400. Then if demand is purchase is for 300 units and the demand is 200 units,
Then to drop back to 400.
what happened?
For 300 units, if there's a demand of 200 units, that means it will become 400 again. No, nothing. You finish the thing, I'll check it, then I'll ask.
Okay, 1600. So there is profit of 400. I'm really sorry, but then somehow I don't. I mean that I there's no clarity. When you get the recording, you will understand. Okay. So here, if they purchase 300 units and they also sell 300 units, so on all these 300 units, profit at the rate of 4 will be earned. So that's 1200. Okay. Now, the number of units that should be purchased at the beginning of each day in order to maximize expected profit is, how many units should they be purchasing? So maximizing the profit. So let's first add them up. In which situation is the profit maximum? When they purchase 200 units, then they have the profit at its maximum, which is 1600. So purchase of 200 units, because these are all uncertain things, whether it would be 100 or 200 or 300. So be it anything, they would be benefited if they have on hand with them 200 units of stock available. That is, if they purchase 200 units, the profit is at its maximum with 1600. Yeah.
Then why did they give us profitability?
This is additional information, but the coming questions we will see what is the use of probability. The question is not touching upon the probability part of it. The expected value is not touched upon. So that is just additional information here in this particular question. But then in the coming questions, we will see that the application of the probability also will be taken into consideration. Yeah. Yeah, please.
Profit, ma'am.
And so the final answer
Will be 200 units. So they should be purchasing 200. The profit will be at maximum when the purchase units is 200. 233. A company has estimated the selling prices and variable cost of one of its product as follows. The selling price is given, the variable cost is also given. The company will be able to supply 1000 units of its product each week irrespective of the selling price. Selling price and variable cost per unit are independent of each other. The probability that the weekly contribution will exceed 20,000 is dash percentage, round to the nearest whole percentage. The selling price to be as 40 or 50 or 60, the chances are given. Okay. Then we also have the variable cost to be as 20 or 30 or 40. Those are also given. Then respective probabilities are also given. So what is the expected selling price? The expected selling price will be 40 into 0.3, 50 into 0.45, 60 into 0.25. Then variable cost will be 20 into 0.55, 30 into 0.25, and 40 into zero point 0.2. When we calculate what is the expected variable cost. But the point here is we are asked to find out the probability that the weekly contribution, what is contribution? Selling price minus variable cost is contribution. So if we are doing if we are calculating the expected selling price, the selling price into probability, the probability has to be calculated. Then similarly for variable cost also we have to multiply that into the probability part of it. But the question is not addressing us to either calculate the expected selling price or calculate the expected variable cost. We are asked to calculate what is the expected contribution. What is the probability that the weekly contribution will exceed 20,000? Contribution should exceed. So step number 1 is we need to find out what is the contribution. Contribution is selling price minus variable cost. Once the contribution is calculated, see individually we see the selling price has to be multiplied into the probability, variable cost also has to be multiplied into the probability. So there are two different probabilities given. So the contribution should be multiplied into both of these probabilities. Okay, let's first mention selling price per unit, either it is 40 or 50 or 60. Then we also have the probability for the selling price. Then we have the variable cost per unit and also have the probability. The probabilities are 0.3, 0.45, then we have 0.25. Then the variable costs are 20, 30, 40. The probabilities are given as 0.55, 0.25, 0.20. Then find out what's contribution. Contribution per unit. So we have to find out what is per unit. Per unit will be selling price minus the variable cost. That gives us contribution per unit. It should exceed 20. It in all the three situations we see that the contribution is only 20. In all three situations we got it as 20, but the question is addressing us what is the probability that the weekly contribution will exceed 20,000, will exceed 20,000. It should be greater than 20,000. So the first situation, if the selling price is 40, if the variable cost is see anything that is either it is 20 or it is 30 or it is 40, it will not give a contribution which is about 20. The maximum what can be earned is only 20. But the question is addressing us to talk about a contribution which is greater than 20,000. The contribution should be greater than 20,000. So the selling price of 40 with the combination of the variable cost as 20, 30, 40, none of them will give. See, if it is 20, maximum contribution is 20. If it is anything above that, 30, then 30 will give a contribution of only 10. 40, zero contribution. So selling price cannot be taken at 40 because 40 with any of these combination also will not give the contribution which is about 20,000. So that possibility is not there. Coming to the next possibility, that is 50. If 50 is taken, if 50 with a combination of 20, 50 minus 20 gives 30. So that is one possibility, one combination of what could be selling price and variable cost. So these are independent, they are not connected. Selling price and variable cost per unit are independent of each other. It is not that when it is 40, it is 20, when it is 50, it is 30. That is not a situation. They are independent of each other. So 40 situation will not allow them to have a contribution which is greater than 20. The max is what they can earn is 20. So that combination doesn't work. 40 with any combination also doesn't work. Coming to 50. 50 and 20. 50 minus 20 gives 30. Then 50 minus 30 is 20. 50 minus 40 is 10. So only one possibility which can be earned. The possible selling prices which can be are 50 works when the variable cost per unit is 20. It doesn't work with 30, it doesn't work with 40. 50 minus 30 gives only 20, 50 minus 40 gives only 10. Coming to 60. When selling price is 60, 60 works 60 and variable cost is 20, it works 60 minus 20, contribution is 40. Then 60 minus 30 also it works. So the another possibility is 60 minus 30, the contribution will be 30. 60 minus 40 again it becomes 20. Do you see that? The possible selling price per unit and variable cost per unit to ensure contribution will exceed 20,000. Okay, then we see that contribution will be definitely above 20,000. It will exceed 20,000. So let's write what is the contribution. So here it is 30, then here it is 40, here it is 30. So the contributions are there. But then along with the contributions, the possibility of such a thing happening. Now they are associated with some amount, some probability values. Uh, 50 has a probability of 0.45 and 20 has a probability of 0.55. For 50, this is the probability. For 20, this is the probability. So contribution should be considered with both the probabilities. So 30 into 0.45 into 0.55. Two probabilities have to be taken into consideration because selling price of 50 is with 0.45. Variable cost of 20 is associated with 0.55. So the expected contribution will be the probabilities into the contribution. Okay, so the expected probability will be the question is also addressing us to find out what is the expected probability. At what probability can they have a contribution which exceeds 20,000? So here the combination is 50 is with I'll write here 0.45 so that it will be easy for you to understand. Then in the next cell I will do the calculation into 0.55. Fine, is equal to 0.45 into 0.55. 60 has a probability of 0.25 into 20 has a probability of 0.55. Then we have 60 has a probability of 0.25 into 30 has a probability of 0.25. Round to the nearest whole. So the expected probability is equal to 45%. These are difficult questions only which are included in your examination kit. Normally we do not see such difficult questions, but maybe CIMA exam pattern has, they are not very simple, they are not very straightforward. The very first question at this, on this note, if it has to be done, it is difficult only. Generally it should start with a very lighter ones. See, as we moved towards the ending, see, the chapters have more difficult questions. The initial ones were very simple, very easy, but as we come till the end, this is the first time I'm teaching P1. So there are difficult questions which are included in the content. You will have all the videos. So after this, I will put all of them in the Google Drive and then give you the link. All the days, every single day. I think only one day I missed the recording. Very late, I realized that recording was not done. So except for that, the rest of the days, every class, what we have done, every bit of the content will be there with you. You can look into that and then listen to that and then practice that. So that will be a great help to you. Okay. Question number 234. X company can choose from 5 mutually exclusive projects. The concept of what is mutually exclusive is any one can be selected. See, the meaning of mutually exclusive is if the happening of one event does not allow the other events to happen, precludes the happening of the other events, is mutually exclusive. The happening of one event precludes the happening of the other events is called as mutually exclusive, which means that from these 5 projects, any one project only can be selected. That is the meaning of it. Okay. The projects will each last for 1 year only, and their net cash flows will be determined by the prevailing market conditions. So market conditions are given as either the market could be poor or good or excellent. These are 3 different possibilities. How the market could be: the market could be poor, the market could be good, the market could be excellent. Then these are 3 different situations, but the cash flows which can be generated from each of the projects, project L, M, N, O and P, the cash flows are given. That table has that. Based on the expected value of the net cash flows, which project should be undertaken. Um, Simple thing is, first we have to just tabulate um, the formula of expected value. EV is equal to, what is EV? Expected value is equal to, how do we do that? The variable cash flow, let's put it as cash flow is C. C should be multiplied into the probability, the sum total of all the 3. So basically here in this particular situation, there are 3 different possible market conditions. What are the market conditions? The market conditions are either it is poor, or it is good, or it is excellent. In each of these things, there is a probability given. We have a probability given. We also have the cash flow given. What is the probability? This is 0.2. If there is a chance that it is poor, the probability is 0.2. The cash flow from L, if we are looking at project L, let's see, if we are looking at project L, the cash flow is 500. Then we see it is 0.5, then it is 0.3. Then we also have the cash flows given. Okay. What should we do? Basically, expected value is the sum total of, we take the cash flow and multiply into probability, add them up, the summation. So that is what is expected value. Like that, we have to do it for all 5 of them. And from among these 5 alternatives, we have to choose which one is better. Any one can be chosen. We cannot have more than one project because they are mutually exclusive. So that is the point what has to be remembered. The formula says expected value is equal to sum total of the cash flows or the variable X into the probability. So we have to multiply these two things. So um, the way we want to present it, either you tabulate, you write it in sentence form or anything, one at a time you take it, that way also is fine. Fine. um, I'm erasing that. First, let's mention what is the market condition. Market condition is poor, or it is good, or it is excellent. Then after that, for all of them, the probabilities are common. Probabilities are common for all of them. These probabilities are 0.2, then we have 0.5, then we have 0.3. So let's take the first one. Let's take projectile. For projectile, we'll write what are the cash flows. The cash flows given are 500, 470, 550. If I'm wrong, just correct me. Then expected cash flow. What is expected cash flow? The probability into the cash flow. So here it would be 0.2 into add them up. Okay. Similarly, let's do and I'm minimizing it so that it fits into the sheet. Okay, you got the point, no? The arrangements can be made later on. Cash flows from project N. Cash flows from sorry. Just tell me 400, 550. Then we have 570. What did I write? Sorry, time is getting wasted. Okay. Just help me out with the figures. What are the cash flows? M is 400. Then we have 550. Then we have 570. Then N is 450. Then we have it as 400. Then 475. Then O is 360. If I make a mistake, please let me know. 400. Then 420. Then we have P. For P, it is 600. Then 500. Then 425. Multiply into probability. So this is 400 into probability. Probabilities are same for all the projects. So just multiply that and then add it up. Then comes N. So these are the expected values. Whichever has a better one has to be chosen. So which one is giving better? L has 500, M has 526, N has 432, O has 398, and P has 497. So from among them, the one which is most profitable is this one. So most profitable. So this has to be selected. So that's question number 234. Um, Question number 235 talks about what is Minimax Regret rule. But before we start with Minimax Regret rule, I would like to solve a question on Maximax, Maximin, and then come to Minimax Regret rule. So we'll take up one question which has these aspects. First, we'll solve that and then come back to this one. Okay. Um, Everywhere Minimax only is given. We'll take it up like that only in the same order. If it comes, then we will see. 236, question number 236 is a match the following. Let's quickly do it here only about the match the following. Match the decision criteria with the assumed approach to risk taken by the decision maker. What are the attitudes towards risk? The response of the investors is associated with the strategy. If somebody who's risk averse, if someone who's a risk averse, he would look at minimizing his return. So that will be Maximin. Somebody,
Can also be Minimax Regret.
what happened?
And there are two risk covers.
I know, that's what I, risk covers I have seen. If it is a risk neutral, it will be
Expected value.
expected value. A risk seeker will look at maximizing the maximum risk, Maximax. Okay. Um, Minimax regret rule. Minimax regret rule is minimizing that. So, Minimax regret rule is also for someone who's not willing to take up the maximum regret. So the regret wants to minimize that. So minimax regret rule also will go with risk covers only. Okay, so that is the strategy which has to be adopted. So let's take it up 235 now. The question says a baker is trying to decide the number of batches of a particular type of bread that he should bake each day. Daily demand ranges from 10 batches to 12 batches. Each batch of bread that is baked and sold yields a positive contribution of $50, but each batch of bread baked that is not sold yields a negative contribution of $20. Assuming that the baker adopts the minimax regret decision rule, the number of batches of bread that he should bake each day is dash batches. The daily demand ranges from 10 batches to 12 batches. Then each batch of bread that is baked and sold yields a positive contribution of $50. But each batch of bread baked that is not sold yields a negative contribution. So, what is that? The number of batches, the demand varies from 10 to 12. That is, it could be 10, the demand could be 10, the demand could be 11, the demand could be 12. So if the demand is 10 or 11 or 12, how many what are these cakes? Bread. How many bread should he bake each day is what has to be decided. He's not sure. It could be 10, it could be 11, it could be 12. See, if it is 10, he bakes 10, then that works out well. He bakes only 10, but the demand happens to be 11, or it is 12, or let's say if he bakes 11, demand could be 10, demand could be 11, demand could be 12. If it is if he bakes 12, demand could be 10, 11, 12. So it is actually a two-way table. So one way, when we see that the number of breads he bakes, so number of breads, and the other way, the demand which is present. The demand could be on one side
there are possibilities of demand. Demand could be 10, 11 or 12. On the other hand, what is the supply? Let's put it as supply. Supply is in terms of he baking the breads. He can bake 10 or 11 or 12. So he can also take a decision about it. He is also not sure about whether it would be 10, 11 or 12. Let's say he makes only 10, and then the situations are either they are 10 or 11 or 12, or he bakes 11, 11 and then it could be 10 or 11 or 12. It could be he bakes 12, it could be 10 or 11 or 12. So basically what do we see? We see that it is a two-way table. One way is the demand being present, another way the number of breads he bakes. Okay, so the supply of the breads which he keeps it available, the availability of the baked breads is what has to be looked into. In this situation, we have to decide on the number of batches of bread that he should bake each day, so that his regret is at its minimum. Minimax regret decision rule. His regret is the opportunity cost. Um, he would regret at at the lowest point. His regret should be at its minimum point. That is the concept here. So first, what should we do? We have to prepare a two-way table. Two-way table. The one aspect of it we should talk about, the supply, which is number of breads baked or number of batches of bread baked. So just write number of breads baked breads. It could be 10, it could be 11, it could be 12. Okay. Then the possibility that the demand is for 10 or 11 or 12. Prepare a two-way table, and then identify what is that he would be regretting is what has to be identified. Um, if there is any regret, if there is any foregone contribution, that has to be mentioned. After that, the regret has to be selected where it is the minimum. Okay, how do we decide? Each batch of bread that is baked and sold yields a positive contribution of $50. But each batch of bread baked that is not sold yields a negative contribution of 20. Unsold stock will give a loss of 20, but sold one will give a profit of 50. Okay. In this case, we have to fill this table up with the contribution. Contribution we've done one similar question above, like this. We filled is this one? We filled like this. Um, Similar thing now also we are going to do. Let's say he baked only 10 breads, and if he baked only 10 breads, and if the demand is 10, all 10 will be sold. If the demand is 11, then also all 10 will be sold because demand is more than the supply. If the demand is 12 also, then all of them will be sold. Nothing will be unsold. So if they sell all 10 of them, then the amount of contribution which will be earned is each bread which is sold will give a contribution of 50. So the profit which can be generated is, I'm directly writing here, it would be is equal to 10. 10 are the breads which are baked. Each bread generating a contribution of 50 is 500. So that will be the situation in all the other cases. There is more demand, in fact. So whatever is the supply, all that supply will be taken up. So 500 is the profit. Let's say if they have baked 11 breads. 11 breads, the second, that is when the demand is 11, when the demand is 12, it will be giving the contribution. But the first situation where they baked 11 but sold, the demand is only 10, one is unsold. Unsold one will give a loss of how much? Unsold one will give a loss of
20.
20. Here we have 10 is the demand, so 10 will contribute a profit of 50, minus 1 is unsold, that will give a loss of 20. Do you see that? 10 into 50 is, because 10 will be sold at 50 each, but 1 is unsold, which gives a loss of 20. Then if the demand is 11, all of them will be sold, 11 into 50. And here also it will be 11 into 50. Coming to 12. 12 also we would write it as is equal to 10 will be sold at the rate of 50, minus 2 will be generating a loss of 20. Then 11 will generate a profit of 50, minus 1 is unsold, which will be 20. Then all of them will be sold is equal to 12 into 50. Okay. So we prepared the contribution what can be earned when the demand is 10 or 11 or 12. Okay. After we do that, see, when would they regret is we, from this the basic tabulated data, we just tabulated the data. From the tabulated data, what we have to do is, now we have to prepare a regret table. Only when the regret table is prepared, we will understand when would they regret the least, when will the regret be at its minimum is what can be understood. Okay, so now based on that we have to prepare a regret table. See, each situation, we have to identify, let's present this one, let's tabulate this, the regret table also. The regret table will, the same scenario about the concept of okay, two-way table, present it. After that, we would be writing about what is the regret. Is there any regret? Is what has to be mentioned. For every situation, we would be writing what is the regret. the demand is 10. No regret here. The demand is 11. Assuming that the baker adopts the Minimax Regret decision rule, the number of batches of bread that should be baked each day. How many should be baked? What is the decision criteria is about deciding on whether 10 should be made or 11 should be made or 12 should be made. If the demand is 10, vertically when we look at, if the demand is 10, okay, these are the contributions. 500, 480 or 460. Let's say when the demand is 10 and which one is better? Baking 10 breads seems to be better, isn't it? See, if the demand is 10 and they also have made 10 breads only, okay, the highest is 500. The highest contribution is 500. If the situation is any of these possibilities and when demand is 10, the maximum contribution is at 500. Okay, if they end up making 10 baked breads and the demand is also 10, will they regret anything? Because that's the maximum. So the regret would be 0. Let's first circle this highest part of it. This is the highest, and in this situation this is the highest. Okay. Let's take up a situation when demand is 10. Okay, if demand is 10, they also made 10, so then they would be earning the maximum amount of contribution, which is 500. Absolutely there would be no regret. Regret will be 0. Regret here will be 0. But let's say the demand is 10, but they have made 11 breads, they baked 11 breads, then the revenue what they can, the contribution what they can generate is 480. So they will have to regret to the extent of 20, because by baking 11 there was one unsold was giving them a loss, so they ended up making only 480, because that loss, the unsold one giving a loss of 20 has brought down their contribution by 20. Demand is only 10 but they ended up making 12, so the regret is to the extent of 40. Coming to when the demand is 11, when the demand is 11, the best possible situation is 550. So when the demand is 11 and the number of breads which I have baked are 11, there is no regret. All 11 of them are sold, no loss, if only profit is there. The best possible situation is with a profit of 550, no regret at all. But demand is 11, but they have less number of baked breads, which is 10. So they will be only able to sell only 10. So 10 is giving them some contribution which is 500, which is less than 550. So the regret will be to the extent of 50. And here the regret will be to the extent of 20. So they are earning contribution less by 20. And here in this situation, it will be 100 is the regret. And here it is 50 is the regret. And then no regret here. Okay. So these are the regrets what we have in each of these situations. If they make 10 breads, okay, if they make 10 breads, then when the demand is 10, 0 regret. When the demand is 11, 50 regret. When the demand is 12, 100 regret. Do you see that? So by making 10 breads, they will overall regret when the demand is 10 or 11 or 12, overall regret is 150. Similarly, for the other situations also, we see regret is sorry, this is not the, we are not totaling it up. We are identifying the maximum regret, mini-max regret rule. See what is the regret which they have, and but actually we can total it up. 150 is that, and this is 70, this is 60. So the maximum regrets are mentioned here. We have mentioned the maximum regrets here. From among them, choose the regret which is at its minimum. So which one is at its minimum? This is from among the highlighted ones are the maximum regrets. So the total regrets when they are taken up, we see 60 is at its minimum. So the overall regret at its minimum is a situation where they bake 12 breads and they would regret only to the extent of 60. If they bake 10, their regret is to the extent of 150. If they bake 11 breads, their regret is to the extent of 70. If they bake 12 breads, their regret is to the extent of 60. So this is the minimum regret from among the maximum regrets. So mini max regret. So how many bread should they bake? They should bake 12 breads. The number of breads that should be baked are 12 to have minimum regret. The next two questions are about different situation. $237. I'll just put you to this, and then we can. 237. So there's a diagram given that is about decision rule. 237 is about decision rule. I still have not explained to you. So, and then 238 is about the standard deviation. 239 is again minimax regret rule. So I'm taking this 239 now, and then I'll put it here, and then we'll work it out to 239. Let's finish off all that which is with Minimax, Maximin, Maximax, all those questions, whatever are there. In a sequence, I will take that and bring it to the Excel file, and then we'll solve them. Then only we'll move to another topic. Okay, question number 239. Chris orders bunches of flowers from a wholesaler, which he then sells on his market stall. Chris has to order the flowers before the demand is known, and any unsold flowers are thrown away at the end of the day. A payoff table below shows the profits Chris can expect based upon the quantity he orders and the level of the demand. So, quantity orders are 20, 30, 40, and 50, and the demand is for 20, 30, 40, and 50. So, from this situation, um, the profits are also tabulated and given to us. Using a Minimax Regret table, the order level that would be selected if Chris applied the Minimax Regret decision criteria is either it is 20, 30, or 40, or 50.